Good morning. Thanks everybody for taking time to learn a little more about qualified opportunity zones. Just a couple of housekeeping items before we get started. In order to qualify for and receive your CE, there will be 3 pop-up questions that will appear in the middle of the presentation. You need to answer those questions and then you can quickly X out of it and you'll be able to see the presentation slides. This does qualify for CFP CE and we are still pending for Ohio Insurance CE. Secondly, thank you to our members who have decided to opt in and advertise in Business First this year for us. We just got the report this morning and we have 61 Central Ohio FPA members who decided to advertise. That's the little headshot sequence that's in the middle. I'm pleasantly surprised that's actually an increase over last year. The COVID-19 world is not knocking us off of our game. Thank you for your participation. A preview of coming attractions. Yes, we're going to have a symposium this year, and yes, we're going to bring Michael Kitchis to your desktop. For those of you that are familiar with Michael, I think you would be hard-pressed to find a better subject matter expert on our profession, and we couldn't be more pleased to have the opportunity to bring him one more time to our members. We expect to have him for 3 sessions during a day-long symposium. Ethics will also be part of that day CE. Watch for the details. We've included some ways to have fun at your home or your office or wherever you're trying to make the COVID-19 world work. I think you'll find that we've put together something that not only gives you high quality content, but I think you should be pleasantly surprised how we're going to mix in a little fun for the day along the way. Now with that, let's get it kicked off. We do have a sponsor today. And once again, I'm going to shout out to our sponsors. We would not be able to offer all of the CE and the events and opportunities that we are able to without our sponsors. Our sponsor today is with Harbor Funds. Matthew is reporting in live from Cleveland, Ohio this morning. He's going to give us a brief update on Harbor Funds before we kick it off on qualified opportunity zones. Once we get to qualified opportunity zones, I'm not going to take the time to reintroduce everybody. Azra and Kaz are both with GBQ, and if you're looking for subject matter experts that make us look smarter than we are, that's why we invite these people in. Not only are we going to get CE, but we're going to get the quality content that allows us to link our clients with the resources they need to move forward. And lastly, mark your calendars. If you didn't see it, August 27th, we are having a real happy hour, not a virtual happy hour, a real happy hour. If you're not comfortable coming out in the COVID-19 world, no harm, no foul. But if you are comfortable coming out up at Olentangy Brewing Company in Lewis Center, we already sent you one invite. You don't have to RSVP, bring your own wallet. I'm not buying everybody's beer. And there's a food truck. It is purely social. We hope you can join us. And with that, I'll throw it to Matthew.
Great. Thanks, Jim, and thank you to all the members of the society for joining today and allowing me to give my short Harbor Funds commercial. And also want to thank you for allowing me or pushing me to actually put on a tie this morning. It has been quite some time for me as a road warrior to put on a tie, and so not saying I'm Superman, but it feels like I'm kind of putting back on that suit and actually in the game as opposed to wearing sweats. So don't hold it against me that I'm wearing a tie. I'd rather be wearing sweats, but I thought it'd be a good way to put a tie on and feel like some bit of normalcy again. So thank you. I'll go ahead and try and share my screen here because I do have a short presentation for those of you who are not familiar with Harbor Funds to introduce our company. This is the first year that we've sponsored the FPA. I am based here in Cleveland, Ohio, is where I recently relocated to from Chicago. Long story short, my wife is from the east side of Cleveland, so we're setting up shop here for the long term, but I'm happy to be a somewhat new Ohio resident. Let me share the screen here, presentation. All right, I think that is being shared. For those of you who are not familiar with Harbor, we are a primarily sub-advised, no-load mutual fund company. We typically price our products effectively, typically at or below the Morningstar category average for that particular asset class. But we're 100% sub-advised, and just to give you a little bit of history, Harbor was actually started in Toledo, Ohio, so just up the road back in 1983. Formerly, we were the subsidiary of Owens, Illinois, the glass bottling company there, and we were hired we were formed to manage their pension plan in the early 80s and pick outside money managers to best manage their pension plan. In the late 80s, when 401ks were becoming more popular and in vogue, Owens, Illinois tasked Harbor to do the same thing that they've been doing on the defined benefit side, on the defined contribution side. And that was to pick outside money managers and offer mutual funds to the plan participants. Only at Owens, Illinois at the time, but these being publicly available mutual funds. The first couple mutual funds that Harbor offered and sub-advisors they picked, you probably know a couple of them. It was Bill Gross's first sub-advised mutual fund at PIMCO. Jennison Associates, who currently manages and still manages our large cap growth fund called Harbor Capital Appreciation, were a couple of the early managers of those funds, and quite frankly, they were very successful. And over time, these publicly available mutual funds garnered more and more interest, both from inside Owens, Illinois, and the assets they're getting from the plan participants, and outside assets that recognize that, hey, these funds had great performance. These are very good sub-advisors, institutional managers. And so they started to garner a lot of assets. In the early 2000s, the fund assets had grown so much that Owens, Illinois, being a glass bottling company, said, we are not a financial services firm, and we have this somewhat large financial service firm under our umbrella. Let's sell that off. And the reason I bring that up is because that's when Harbor's business really got institutionalized, is in the early 2000s. And I think what people inside Harbor and the eventual purchasers realized was that Harbor had this embedded knowledge base of heavy due diligence, strong manager research, and able to pick institutional quality firms that didn't have a mutual fund vehicle, and that we had identified some of the ones that are best in class and were very strong in identifying those types of managers. So that's when Harbor's business really got institutionalized and began to expand more and more to the current day state, where we offer 27 funds and have almost $50 billion in assets under management. And really, it's going back to that exceptional manager research, and that's what we're good at. That's what we're known for, and we really it's kind of a go anywhere mindset, as we have on this page, where we'll look in different asset classes if we think an asset class has a lot of potential, or we'll also have meetings and take ideas from different institutional sub-advisors. And our process is very rigorous. It tends to be long. It's based both on quantitative and qualitative factors. And we take a fiduciary mindset, where Harbor is an independent entity from many of these different sub-advisors, and we take that really with great pride, that we're going to evaluate and do what's best in the best interest of the shareholders and potential shareholders when we evaluate managers and come out with a different fund. This brings us a lot of traction as far as who we meet with and who we evaluate, both current sub-advisors and prospective managers. And this slide just shows last year there were 374 research meetings, which is quite a bit. And these are done by a very experienced team of manager research people. Just for example, our CIO, Brian Collins, was the head of manager research for Mercer up until 2004 when he joined Harbor. There are former Morningstar analysts on this page. There are former institutional consulting analysts. So really a broad array of manager research and experienced manager research people that we've given extensive tools, quantitative tools, style, attribution, things of that nature, to really dig down and find what makes a potential manager or our current managers be able to implement a philosophy and process that is sustainable and provide value for our clients over time. We tend to partner with boutique type firms that don't have a mutual fund vehicle. These tend to be somewhat unknown firms, but over time, like for example, in a PIMCO or Genesis Associates, these firms do grow and are more well-known names. But when they start off, they tend to be not so well-known names. So on the page, Wellington's a supervisor of our mid-cap growth fund. PIMCO obviously is a supervisor of our bond fund. But other firms such as Cedar Street Asset Management, which manages our international small cap fund, are less well known. And these oftentimes are firms that there's maybe a portfolio manager at a larger organization, say, I don't know, a JP Morgan or Wells Fargo, that says, you know what, I don't want to be a part of this big corporate culture. I'm not doing what I want to do the most, and that's manage money. And so they'll go off and they'll start their own firm, and they'll say, hey, I know how to manage this international small cap portfolio, but I need help with the distribution. And that's where Harbor comes in. And as we evaluate them and decide that, hey, this is a really good manager, we partner with them. We also have found a niche in partnering with European-based firms that want exposure to the U.S. There are many European firms that do asset management really well. And so we've got a little niche partnering with them. I'll flip forward to just a couple of slides here, and I believe I'm running up on time. So, what makes Harbor unique? And that's that we look for institutional firms that tend to be boutique, and we look at it from that independent fiduciary mindset. And traditionally, we've been kind of Morningstar style box oriented. So we have many different asset management firms managing money in funds across all the Morningstar style boxes. And we're starting to look outside the Morningstar style boxes, where we're looking for things, and we have funds now which are low volatility funds that exploit an anomaly in the marketplace that you may have heard about called the low volatility anomaly, which low volatility stocks tend to outperform over time with less risk. More concentrated funds. Those are the kinds of things that we have started to venture into. We also have started to come out with more thought leadership and more value add pieces, as you see on this page. We have presentations that you can utilize with your clients on, hey, what do we think about what are some great income sources right now? How to maneuver through volatility, going against the grain, which is a kind of a why we believe value is a good place to be right now. And we also have asset allocation perspectives with a new multi-asset viewpoint. So, what do we like right now in terms of asset allocation? So those are non-product related that Harbor has never done before, that we've always had that institutional knowledge, but over the last year and a half or so, we said, we need to provide more than just great mutual fund products. And some of these pieces are available to you and the FPA Society if you're interested. With that, I think I've run up against my time here. So thank you for allowing me to speak about Harbor. I'd be happy to speak to anyone individually more, and I'll turn it over to the Opportunity Zones, as I myself consider myself an investment geek, and I'm looking forward to the presentation as well.
Just a quick reminder before Jim gets back on here, because I know a few of you joined after, but if you need Ohio insurance credit, be sure to answer the 3 poll questions that pop up. Once you answer them, click the X so you can get back to watching the presentation. If you don't need credit, you can simply X out of the poll question when you see it come up. All right, thank you.
Okay, good morning. Debbie, can you see my slides?
Yes, perfect.
Okay, perfect. Good morning, everyone. And thank you for joining us today or this morning for the Qualified Opportunity Zones seminar. My name is Azra Nakicevic, and I am a tax partner with GBQ Partners, and my co-presenter today is Unalan, also a tax partner with GBQ Partners. So today we are going to talk about the opportunity zones and how the program got started, what the goals of the program are, what the rules are for the investors as well as the opportunity funds, and also try to look at it a little bit from the current economic perspective with the pandemic going on, and how we can think about it in relationship to what's happening around us. And so to start out, this bill was passed in December of 2017, and a lot has happened in those 30+ months since it was first enacted. So stepping back again to 2017, when this came out with the Tax Cuts and Jobs Act, or the tax reform, this piece of legislation was one of the very few pieces that had bipartisan support. And because of this, we think that there may be a strong initiative to keep this as part of the recovery as well, and perhaps extending the opportunity zones even further, as well as the deferred gain recognition to allow potentially additional investment into the zones that are in real need for these investments. So the spirit of the law was basically to take privatized money and invest in these underserved communities. In order to have the investments coming into these areas, though, the Congress had to provide some tax incentives for the investors. So at the time the law was passed, it was estimated that U.S. investors had over 2.3 trillion in unrealized capital gains, and the projection was that about 100 billion of those unrealized gains could potentially be invested in opportunity zones. Currently, it's estimated, although there is no real tracking mechanism, but it is estimated that there has been about $10 billion invested in the opportunity zones since it was first enacted. The investments initially had a pretty slow start, and partially it was because the guidance was not issued right away. So the statute came out at the end of 2017, but we really didn't have any rules in the form of the regulations. And so in 2019, it picked up when the proposed regulations were issued, and then particularly towards the end of 2019, there was a lot of new funds being formed and a lot of money coming into these funds, mostly because one of the incentives that was given with these opportunity zones was going away at the end of 2019. And then getting into this year, in January and February, before the pandemic hit, the final regulations were issued. And so the investments continued strong in those first couple months. And there was a lot more certainty for the investors as well as the funds on how the rules would be applied. And so a lot of people were forming new funds and the investments were coming in. What we have seen recently is that there has been some slowdown in the investments getting into the funds, as well as the new projects getting off ground and existing projects being delayed. All right, let's move to the next slide. So how did the opportunity zones get designated? Basically, each state was tasked with picking no more than 25% of the already existing low-income community tracts as a qualified opportunity zone. And each state was doing these, picking their tracts separately, and this process of designating the tracts has now been completed. What we ended up with was more than 8,700 designated opportunity zones in all of the 50 states, and then the entire territory of Puerto Rico is also an opportunity zone. There has been a lot of discussions about potentially extending these zones to all of the low-income community areas. Most of the activity that we have seen has been with real estate developments in the opportunity zones, although the program is available for the operating businesses as well. And from our experience, most of these real estate developments and new startups have been in the urban areas as well. All right. Okay, let's flip to the next slide. This slide is just basically giving you a couple of different links. We'll be sending the slides to everybody, hopefully after the call, where you can click on the link and see where the opportunity zones are in the state of Ohio as well as nationally. Okay, Kaz.
Yep, good. Thanks, Azra.
Kaz, you're on mute.
There we go. Sorry. Got a fat finger there hitting this. So again, thanks everyone for having us today, and appreciate the opportunity. So wanted to start off by talking about the 3 tax benefits of investing in an opportunity zone. And the first one is the temporary deferral of the capital gains reinvested in the fund. The slide here just mentions the gain. The deferred gain must be recognized prior to December 31, 2026, or the date in which the Oz investment is disposed. And you'd be surprised, at least with clients I've talked to, how we get questions about opportunity zones and them just not understanding that in order for this program to even have an opportunity to look at this or think about it, you have to have a capital gain. Have many conversations with clients related to that. So we kind of put a bold note there that no benefits are available unless there's a capital gain. So we always kind of say it always starts with a capital gain. But again, the big benefit there is the deferral of the tax related to that gain being reinvested. And just on a side note, I think everybody in this group, has obviously got their eyes on the market, and the market's still very strong. So there's a lot of probably realized and unrealized capital gains out there, but we're still seeing a lot of activity on the M&A front within our client base. So clients, still robust in terms of buying and selling businesses, and obviously those that are selling businesses, those gains would qualify for this. And we'll talk a little bit more about kind of the specifics related to that. But again, it all starts with capital gain for the program here. The second benefit is the ability to eliminate part of the tax on that capital gain. So the mechanism for there is that your basis is increased. Kind of the first tranche is it's 10%. The basis is increased by 10% if the investment is held for more than 5 years, an additional 5% if it's held for at least 7 years. So there's a permanent exclusion of 15% of that capital gain. So easy math, if you have a $100,000 capital gain that you invest in the fund, if you meet all those parameters, you only pay tax on $85,000. The one big note on this is that we're past the period for the 5% basis step up. So in order to get that 5%, you would have had to invest into a fund by 12/31/19. But that's still that 10% exclusion is still out there, and that investment would need to be made by 12/31/21. So just a couple dates there to keep in mind related to the basis increase benefit of the opportunity zone. The third benefit is elimination of capital gains tax on the appreciation of the investment that's held within the Qualified Opportunity Zone Fund, as long as you hold it for 10 years or more. So, we view that as really probably the real big benefit there is the permanent exclusion of any appreciation on that new investment. And we're seeing that with, I think Azra mentioned some of the deals we've worked on. People are putting together books or pro formas on kind of benefits of the investment deal itself, and then kind of layering in some of these tax benefits related to it to kind of look at the full picture. So absolutely something to keep in mind as your clients are looking at this is, would obviously be tax efficient and save some dollars.
And Kaz, the only thing I would add there is this 10-year holding period. Some of our clients get turned off because sometimes a lot of the clients are short-term holders. They don't anticipate holding their, especially real property in the environment that we had for the past 5-6 years for 10 years. But really, that is the biggest benefit. So for some investors, it may not make sense if they are not planning on holding it for a long term. It would still make sense in terms that that initial deferral, they could still save 10% on the tax that they would otherwise be paying. But just something to evaluate when you're talking to your clients.
That's a good point. So kind of looking at opportunity zones versus other tax incentives, and we just kind of put a couple different buckets here in terms of how you can think about it or your clients should be thinking about it. One, very flexible. I think I mentioned that off the top here, you know, any kind of asset sale that generates capital gains. So we're talking about real estate, stocks, bonds. We have art, coins. I mentioned privately held businesses. It can be investments in real estate and companies, equipment, investments through partnerships or corporations, anything again that generates a capital gain. So the flexibility there as compared to other like 1031 exchanges where it's got to be real estate, and we're going to talk about that a little later too. Just the flexibility there makes it attractive. The other thing too is very simple. All this is self-certified. It's just forms that are required to be filed with the IRS. So obviously things that we're getting involved in with our clients here in these funds is helping them go through the self-certification process and just handling the compliance related to that. And then we put in there scalable. And again, this is just something, no competitive process like some credits or incentives where you're trying to gain leverage on, moving from one city to another, or at least our business clients aren't, or attracting jobs or things of that nature. Not any part of this program. No limit on how big investment can be. And then the tax benefits, again, just running the math, there's no limitation on how that would work, otherwise falling within the rules. So, very, very good program from that perspective. So here I wanted to talk a little bit about, how the funds are set up and what it might look like. In this flow chart here, and we'll talk about each of the different categories here. But up top is the Qualified Opportunity Fund, which can either be in the form of a partnership or a corporation. Obviously for a partnership, it's got to be more than one partner in that partnership to be treated as a partnership for federal tax purposes, or a corporation. And again, those are both two entity types that qualify to be a fund. And then the fund itself could have a direct investment in qualified opportunity zone property. That's the blue box or circle, I guess, right below there. They can have a direct investment into that property, or the fund could have an indirect investment off to the side there, to the left and the right, in qualified opportunity zone stock or qualified opportunity zone partnership interest, where those two entities then would have an investment in qualified opportunity zone business property. So again, just a little bit of detail there related to the structure and how the fund should be set up related to these investments.
I would just add that in most cases, the funds will have this what we call a tier structured, although the fund, like the chart shows, could own the qualified property or an asset directly. In most cases, which we will talk about later, the reasons are mostly for meeting the testing requirements under the Opportunity Zone regulations. So in most cases, the investor will come into the fund, and the fund will, instead of buying the qualifying asset directly, invest in an underlying business that will be another partnership or a C corporation. And then that underlying entity will actually own the asset that is in the Opportunity Zone. And we'll talk about it a little bit more, a little bit more detail later.
Yeah. And then, as we were mentioning, kind of the definitions here. So Qualified Opportunity Zone Fund, that was the circle at the top of the chart there. So I think the big takeaway there is that at least 90% of what it's invested in has to be, Qualified Opportunity Zone property or an investment in order to meet the requirements related to being a fund. So that's important to keep in mind. And then as far as the property goes, there's three different buckets here of Qualified Opportunity Zone property. So the first one there is Qualified Opportunity Zone stock. And so that would be stock held in a corporation, a domestic corporation, where at least 90% of that business qualifies or is in the zone. And it needs to be acquired after December 31st, 2017. That's going to be a common date we're going to see in all these here. Related to qualifying for the opportunity zones. And then we also mentioned partnership. Again, kind of same concept here, except held through a partnership investment where it's a capital or profits interest, in a domestic partnership where, again, substantially all of its investment needs to be at least 90% and acquired before December 31, 2017. And then qualified opportunities zone business property, so tangible property used in the trade or business. Again, the big example there, I think, would be real estate that we see a lot of. You know, there's some rules related to, you know, the property and substantially improving the property. We're going to talk about that. But again, and it has to be acquired from an unrelated property after December 31, 2017. Next slide. And then the last one here is qualified opportunity zone business. So this would be an operating trade or business where, you know, substantially, and they define that as 70% of its property is owned or leased in the opportunity zone. And again, this is an operating business, and where at least 50% of its total gross income is from the active, you know, trade or business in the opportunity zone. And we've talked to a couple clients about this, and so that's one thing to be cognizant of in terms of the gross income and where it's derived in order to meet the requirements. And then there's also another requirement about this intangible property used in the trade or business. 40% you know, has to be qualified in the zone. Then we talk about here that there's a less than 5% of its unadjusted basis in property is attributable non-qualified financial property. So that's cash. You can't sit on a bunch of cash for a long period of time. And then there's an exclusion here for, you know, certain types of businesses. So, you know, golf courses, country club, massage parlors, all these other, I think they kind of categorize these as sin businesses, or we've seen that in other tax provisions where certain benefits are excluded from those types of businesses, and that falls, you know, into that category as well.
Okay, great. Yeah, just kind of looking at this slide, seems like there is a lot of different regulations and rules really for the funds to meet. And if you think about it, for the operating businesses that want to be qualified opportunity funds, let's just think about a startup that moves into the opportunity zone. They would have to ensure that they meet all of these rules in order to be treated as a qualified opportunity fund, because if operating businesses is providing services or goods both within the zone and outside of the zone, they would need to ensure, you know, that more than 50% of their gross income is derived from providing services or goods within the zone. I think with real estate, that's a little bit different because obviously that asset is not movable. And so that's probably one of the reasons why we are seeing a lot more real estate deals with qualified opportunity zones. It's just a little bit easier to fall into all these buckets that are required. But I would also say we have talked to a number of different clients that have thought about purchasing businesses and running them out of the opportunity zones. In some cases, it has not worked out, mostly because of these rules didn't fit in for their facts and circumstances. But we have seen a couple of deals locally that that have worked as far as the operating businesses. All right, so let's look at this example. There's a lot going on this slide, but basically what this slide is trying to show is potentially the benefits and enhanced return on investments for investors putting their cash into qualified opportunity fund versus a traditional fund, assuming all things are equal. And so in this case, in both of these cases, we have an investor that has a realized capital gain of $1 million in 2020. And they can either invest in a qualified opportunity fund or a traditional investment. And so let's assume in both cases that that investment is going to grow on average 7% a year. And then just to keep it simple, let's assume that there is only federal income tax and there is no state and local taxation, and then also assuming that capital gain tax rates during the investment period remain unchanged. In this case, we're using 23.8%, which is the capital gain tax rates currently in place. And so looking into qualified opportunity fund investment, as Kaz talked earlier, that $1 million that gets invested into the fund, the investor would be able to defer the tax on that gain and not have to pay it at the time the gain is realized. So that $1 million will then grow 7% on average annually. And at the end of 2026, that's the end of the deferral period. So every investor in the fund will have to pay the tax on that deferred gain. And if they have held that investment, the fund investment, for 5 years, they will, instead of paying tax on 100% of the deferred gain, they will only pay the tax on the 90%, and that remaining 10% will never be taxed. So that's one of the benefits as well that we talked about. And then assuming that investment is held for 10 years, the investor will dispose of that investment in 2030, and using our 7% growth, that investment will have the value of close to $2 million. And so that's where the final benefit kicks on the exit, that basically appreciation from $1 million originally invested to almost $2 million over 10 years. That $1 million of increase in value on the fund investment will not be subject to tax. And so when we subtract the tax that had to be paid in 2026, the investor will have cash in hand of about $1.7 million. And compare that to the traditional investment, similarly, $1 million capital gain is realized, but before it's invested into this traditional fund, the taxpayer will have to pay the tax on that gain of $238,000, so that only $762,000 will be left to invest into a traditional fund. That money then grows over 10 years to close to $1.5 million, and the investment is disposed in 2030, similar to the opportunity fund investment. However, the difference here is once this traditional investment is disposed of in 2030, again, the investor will be subject to tax on that increase in value from $762 to almost $1.5 million, and will have to pay the capital gain tax on it of $175. So the bottom line is, all things kept equal, you can see the difference here on our potential return on an investment between the opportunity fund and a traditional investment, given that there are all these tax incentives for the investors to put their cash into the opportunity zones.
Hey, Azra, we had a question come in
Sure.
related to that. It says, for capital gains that a fund kicks out within the 10 years, how are those taxed? So,
say that again.
For capital gains that a fund kicks out within the 10 years, how are those taxed?
Yeah, so we'll talk about it a little bit later, but essentially, if the fund disposes of an asset, the fund could defer, could reinvest the gain into another qualified opportunity asset. What happens though, the gain that's realized on the disposal will be taxed to the investors, but if the cash is reinvested into another qualifying property, that 10-year holding period for the investor will continue. And so essentially what happens is, at the end of 10 years, that because you had to pay the tax on that disposal within 10 years, you will still have the benefits on the eventual final exit, but the return on investment will be diminished because the fund had to pay the tax on that midpoint disposal.
And then there was a little bit of a second part, says if the fund kicks out income during that period, and I think the answer to that is it would just be treated as normal investment.
Just treat it as a normal investment. It would be taxable using the ordinary income tax rates to the investors.
Yeah, and then return of capital, if that's a distribution, same deal. If they are basis non.
I think a little bit of caution needs to be exercised with respect to the distributions, and I think that will come later in the slides, because that initial investment is tax deferred. In our example, $1 million, for example, the initial basis for the investor when they put their $1 million into the fund is going to be zero until they recognize that deferred gain in 2026. And so the tax rules are such that if the fund makes distribution to the investor that's in excess of their basis, that's basically going to be a gain to the investor. And so that would require some analysis to make sure that there is sufficient basis for those distributions, especially in those initial few years before that deferred gain is recognized. So here's kind of step-by-step how the opportunity zone investment would work. And so first, you would have to form a qualified opportunity fund, which, like Kaz said, could be a partnership or could be a C corporation. The fund would then have to self-certify annually on the forms that we talked about that are attached to the fund's tax return. And then once the fund is formed, then you would have investors who had realized capital gains invest their cash into the fund within 180 days from that gain being realized. And like I said before, that investor would defer the tax on the gain that's reinvested into the fund and would take the initial basis in a fund of zero. That basis would then go up when the deferred gain is recognized, and would also go up as the fund recognizes income from its operations and allocates it to the investors. And then the next step would be after the cash is contributed to the fund would take that cash and either acquire the property, the qualifying property in an opportunity zone, or if that property does not meet the original use test, we'll talk about it as well, the fund would have to substantially improve the property that they purchased in the opportunity zone. The fund would then have to, once the investor holds the interest in the fund for 5 years, then the investor gets that step up in basis and of 10% on the deferred gain. Just a second. That will offset some of his gain when it gets recognized. And then in any event, like we talked about, at the end of 2026, that deferred gain, the tax on that deferred gain will have to be paid if the investor is still holding their interest in the fund. And then finally, the 10-year holding period, either the fund would dispose the asset or the investor would dispose their interest in the fund. If that happens after 10 years, then basically the investor would get a fair market value basis step up so that any appreciation in the value in their interest would be excluded from tax when that interest or the asset gets sold. All right, so next few slides, let me see, did I skip it? Yes. We'll talk about basically how the rules evolved over the last 30 plus months and get a little bit more into detail what the technical rules are for the funds as well as the investors. And so, as we know, the Opportunity Zone statute came with the tax reform at the end of 2017, and then the proposed regulations were first issued by Treasury in the fall of 2018. And the second set of proposed regulations came in spring of 2019 with additional rules, and as each set of these regulations came out, each one of them was probably 400 plus pages, so you can quickly see how complicated these rules can get. And then finally, at the beginning of this year, the final regulations were issued, and with those regulations now we have final set of rules that the fund and investors can follow. And these final regs were pretty favorable for the funds and investors and provided more flexibility for the investors as to what type of gains can go in, the timing of investments, as well as more flexibility on the eventual exit from the funds. So the investment in the fund has to be an equity interest. So it can be in the form of limited liability membership interest, partnership interest, corporate stock. What it cannot be a debt instrument. You cannot have an investor loaning money to the fund and treating that investment or return on that investment as qualifying for the Opportunity Zone incentives. And only the gains that are capital in nature can be deferred into qualified opportunity fund projects. We talked about that earlier already. The capital gains could be short-term gains, could be long-term gains. They can be Section 1231 gains, which are generally type of gains that are generated from the sale of real property. However, the character of that gain will be retained throughout the deferral period. And so what that means is if an investor had a short-term capital gain in 2020, that they defer the tax by investing it into the Opportunity Fund. At the end of the deferral period in 2026, they will have to pay the tax on that gain using the short-term capital gain rates that are in effect in 2026. And so they will retain their short-term qualification, but they will also be subject to the tax rates that are in effect in 2026, which could potentially change down the road. Any type of taxpayer that recognizing capital gain is eligible to defer those gains by investing into the fund. So you could have an individual investor in the fund. It could be a trust. It could be a corporation. It could also be a partnership. And the big one here is that the eligible gains may not arise from a transaction with a related party. We've had a number of clients that maybe have identified properties within opportunity zones that they wanted to develop, but they didn't necessarily have capital gains. And so then they would come with these potential ideas, maybe sell some other piece of property to a related entity that they own and use those gains to invest into the fund and buy the new property. But generally, that type of gain will not work. It has to be gain from a transaction with an unrelated party. And also the fund cannot buy property from a related party, which means anyone who owns 20% or more of the fund interest, the fund cannot buy the property from them. All right, so we talked about this 180-day reinvestment period. So as we said, the investor has 180 days from the capital gain being realized in general to invest into the fund and be able to defer those gains. That's certainly true with individual and trusts. But like we said, partnerships can also invest into the funds. And so the same rule for 180-day reinvestment period applies for the partnership. But if the partnership decides not to defer the gain, then one or more of the individual partners in the partnership can take their share of their allocable share of the gain from that partnership and invest it into the opportunity fund. There is a little bit more flexibility in this case for this reinvestment period, because the partners will then have 3 different options from which to choose when to start their 180-day clock. And if that's the case, they could start their 180-day clock on the day the partnership realized the gain, just the general rule. They could start the clock on the last day of the year when the gain is recognized by the partnership, or they could start their 180-day clock on March 15th of the following year, which is the tax return due date for that partnership that had generated a gain in a previous year. This really provides a lot more flexibility for the individual investors and provides them additional timing to make decisions when and where to invest those gains, particularly, you know, if you have funds that may not need funding or may not be ready to take the cash from the investors at the time the gains are originally realized. Sorry. So qualified opportunity fund, like we said, will have to meet some testing rules in order to be treated as a fund. Otherwise, the fund may be subject to penalties for not meeting the asset test. And so 90% of the fund assets will have to be qualified assets. And that testing is done every 6 months. If the fund has, so how do we determine the value of those assets for the testing purposes? If the fund has the audited financial statements, then you would use the values provided in those financial statements for the testing purposes, which would generally be based on fair market value. But a lot of funds, particularly smaller funds that are not institutionalized funds, would not necessarily have audited financial statements. And so in that case, the IRS basically said you can use a cost basis of your assets for the purposes of the 90% testing. The other thing that regulations provided is that you could have investors that don't have capital gains invest into the fund. And we've seen that in some instances too, where, and in that case, if you basically have to bifurcate the investments between, at the fund level, between the qualifying investors and non-qualifying investors and track them like that, because anybody who's putting the money into the fund that are not qualifying capital gains, they would not be eligible for any of the incentives. Unfortunately, it's only the capital gain investors that will benefit. And we've seen this in a couple of instances, and where feasible, because of this additional tracking, sometimes the clients would set up a parallel fund that's not going to be opportunity fund. And so the investors with capital gains would come into the qualified opportunity fund, and then everybody else that's just putting regular cash would come into the parallel fund, which would just be another partnership most likely, and then together those funds would buy the opportunity zone property. The opportunity zone incentives are set to expire at the end of 2047. So that's a long time from now. Anybody who sells their investment in the fund after that date will basically be taxed on their gain at the disposal. So anybody who sells obviously before that time would sell it tax-free. All right, so here's the working capital safe harbor. And so like Kaz, I believe, mentioned before, generally cash is a bad asset for the purposes of this 90% asset testing. And so when you think about it, the investors will have 180 days to put the cash into the funds, but the fund then at the end of every 6 months will have to perform testing, and if they're sitting on a lot of cash, that cash is going to be making them fail that asset and potentially asset test and subject to the penalties. And so with this working capital safe harbor, that basically avoids cash being treated as a bad asset. And the way it's done is that's where the tier structure comes into play. If that cash is invested into the fund would then have to push it down to an underlying lower tier entity. And that entity can use a working capital safe harbor for 31 months. It can essentially treat that cash that it's sitting as a working capital and treat it as a good asset for the testing purposes. And so this is very welcomed by a lot of real estate developers as well as startup companies, because if you think about a life cycle of a project, it takes time, particularly if you are developing property from scratch, to put that cash into use and develop the property or buy the assets for startup companies. That working capital safe harbor is not violated if there is a delay due to government action. So that's very much applicable in today's environment, but many things being shut down at the beginning of the pandemic, that there has been a lot of delays in getting the permits from the government or perhaps getting rezoning done. And so if that 31-month safe harbor, working capital safe harbor exceeds the 31 months, as long as it's due to government delay, that fund will not be penalized for exceeding that 31-month development period. And then finally, the regulations do say for the incentives to work, the fund has to either invest or operate an active trade or business. And so what that means for real estate is that the triple net lease arrangements would not work because the IRS does not view triple net leases as an active trade or business. And in those cases, the funds or the owners of the real property would generally have to renegotiate their leases in order to fall within the rules and avoid a triple net lease treatment. And I think we briefly touched on this earlier. So the fund could own the property in the opportunity zone directly, but it could also lease property. And so if you have a startup business, they could just lease offices in the opportunity zone and be able to meet their asset testing and qualified for the incentives. The requirements are basically similar to the property being purchased. The lease has to be entered after the end of 2017. It has to be an arm's length lease, and during most of the period that the fund holds the lease, that lease property has to be used in the opportunity zone. Okay, so let's talk about inclusion events here really brief. There are a couple of different ways that the investor could trigger that deferred gain. I mean, the obvious one is if the investor sells the interest in a fund, that deferred gain is going to be immediately triggered. Transfer by gift would also be a triggering event. If the fund sells the assets, that would also be a triggering event. Also, although as we have said earlier, the fund could then reinvest and potentially continue some of the incentives for the remaining life of the fund. Some items that do not cause gain to be triggered is transfer of interest in the fund by death. If the individual investor transfers the fund interest to its own grantor trust, that's not going to cause gain to be recognized. Any tax-free transactions under 721 and Section 381 are also not triggering events. So that would be, for example, if investor owned a property or owned the opportunity fund investment and contributed it into another partnership in exchange for that partnership interest, that would be okay and would not be taxable to the investor. And then lastly, the debt finance distributions, where a lot of times, especially in real estate context, you would have the entity potentially refinance the property, and upon the refinance, distribute some of the proceeds from the refinance to its partners. And as long as the partner has a basis to take that distribution, and that distribution is happening more than 2 years after initial investment, that finance distribution will not generate gain to the investors. Sale of qualified opportunity fund interest or sale of assets by qualified opportunity fund. And originally, when the proposed regs came out, they were pretty narrow in that they only allowed the investors to sell their interest in a fund in order to benefit from that exclusion of gain on the exit. That was a pretty narrow interpretation because if you think about it, the investors could have a hard time finding a potential buyer that's ready or willing to buy the interest in the fund. A lot of times the buyers would want to buy the asset directly, and so when the final regulations were issued, they basically allowed that exclusion from gain, whether or not the investor is selling their interest in the fund or the fund is selling its underlying assets. The only piece of gain that would be recognized if the fund held inventory type of property that's generally treated as ordinary income, that would have to be recognized. Sale of qualified opportunity zone property within the 10-year holding period. We talked about that in a question we had. What happens if the investor sells interest in a fund during the 10-year holding period? So as long as the investor reinvests those proceeds within 180 days, they would not have to recognize income. However, those reinvested proceeds into another fund, it would restart the 10-year holding period, unfortunately. Okay, so these are two important requirements for the testing: original use test and substantial improvement. And like we said, for the fund to have a qualifying asset, that asset has to be in the opportunity zone, but it also has to meet the original use test or substantial improvement. And basically what original use test means is that that asset has never been used in the opportunity zone before. And in a real estate context, what that means is that if you buy let's say a parcel that is in the opportunity zone tract and put a brand new building on that land, that would meet the original use test because that building has never been used before. If the fund purchases the building that has been vacant for more than 5 years, then that building would also meet the original use test. Otherwise, the fund would need to meet a substantial improvement if they cannot meet the original use test. So again, getting back to real estate example, the fund purchases an existing building and plans to that building would not meet the original use test. What they would have to do is basically substantially improve that building through renovation or rehab, which substantial improvement basically means, for these purposes, doubling the basis in the property during the 30-month period. So if the building was purchased for $1 million, the fund would have to spend another $1 million during the 30-month period for that building to qualify as a good asset for testing purposes.
Okay, thanks, Azra. I'm going to take a few minutes here and kind of come back to, I guess, a couple points I mentioned earlier. So opportunity zones compared to 1031 exchanges. So, out of the gate, qualified opportunity zones, once you have that capital gain, you have 180 days from the time the gain is realized to make the reinvestment. Again, we mentioned this earlier, but this differs from 1031s, in a couple ways here. One, which I think,